Warren Buffett once said, "Only when you combine sound intellect with emotional discipline do you get rational behaviour." As the quote correctly states, emotional control is one of the many things that are destined to be on the head of any investor's list of safeguards. Fear and greed are two opposing and powerful emotions that might impact an investor's choice to invest. Emotions in the share market are risky. It has the potential to deplete your assets and compromise your life ambitions. And as a result, it's critical to keep your emotions under check. Emotional investing is a type of investment in which you make decisions based on market fluctuations rather than cold hard facts. It is composed of fear, greed, anxiety, and optimism. This sort of investment is affected by market movements and is based on an investor's behavioural instincts. Rather, it is a cycle in which investors react to market volatility and fluctuations. On that note, let's look at the few tips on how to avoid emotional investing. Learn to distinguish between stock and business performance. Investors frequently mix up stock performance with business performance. You must change your focus from share price fluctuation to fundamental business success. It is worth noting that a bull run frequently accelerates a fundamentally poor stock, making it appear appealing. Similarly, good stocks suffer during a bad market. Before you decide to pour or pull money in any situation, consider the business basics. Fundamentals such as, is the firm profitable? What is the track record of the promoters? What is the company's future worth? And how solid are the company's fundamentals must be examined. Stop monitoring your investments on a daily basis. Stop monitoring your investments on a daily basis to decrease the emotional effect of market volatility. During market instability, continuously reviewing your money raises anxiety and leaves you subject to emotional investing. Avoid timing the markets. Time in the market is highly important than timing in the market. Even the most experienced investor cannot anticipate when stocks will rise or fall. Also, remember that the market's performance is not identical to your own portfolios. Market timing raises the likelihood of making incorrect judgments, which might jeopardize important life goals. Bull versus bear markets. In the stock market, a bull market is defined as a situation in which share prices are rising or expected to rise. Other assets such as currencies, commodities, bonds and real estate can also be used. When the bull runs wild and investor sentiment becomes euphoric, investors may notice market possibilities or learn about investments from others, such as the news, friends, co-workers or even family, which may urge them to venture into new territory. The investor's eagerness may inspire them to strive to profit from emerging investments due to optimistic market conditions. And meanwhile, bear market occurs when the values of assets remain in a downward trend for an extended length of time. Pessimism and panic pervade the market, resulting in constant selling pressure from market participants and a decline. Bear markets may be tough to handle when equities assets lose value and safe havens become more appealing owing to increased returns. And during these times, deciding whether to invest in shares at market lows or buy cash and interest-bearing goods might be difficult. Dollar cost averaging and diversification are two prominent investment strategies, and these can remove some uncertainty from investment decisions while lowering the danger of bad timing due to emotional investing. The dollar cost averaging of investment is highly effective. Dollar cost averaging is a method used by investors to manage price risk after making an investment in stocks or mutual funds. It is an investing technique in which investors split the whole amount of money they wish to spend into acquiring little quantities of a certain asset at consistent intervals throughout a period of time. To reduce the influence of inconsistency on an investor's overall buy, the investor prefers to invest using dollar cost averaging, instead investing the entire amount in a certain asset at a time or with a single purchase. And this investing strategy decreases an investor's price risk, and this means he or she may have to pay more for a certain investment at a single time before market prices decline. While diversification is a risk mitigation method widely used in various risk management strategies, it seeks to disperse possible risk among a number of variables, allowing for the square-off movement of variables in a group. One of the risk management strategies employed in portfolio optimization is diversification. The proverb, "all the eggs in a basket," is well recognised. A varied portfolio is advantageous for investing, but too much variety may also be detrimental. Thanks so much for watching. Please do like, share, comment, keep watching for more market insights and business news. Sage for Kalkine Media.
Right now, Kalkine is offering a 7-day free trial on its premium research reports. Get access to data-driven market insights combined with an in-depth analysis on financial markets across the globe. Don't miss it. Subscribe for the free trial now.